Thursday the 6th brings the latest interest rate decision from the European Central Bank. It also comes alongside shifts in terms of economic forecasts from the group. So let's look at what to expect for this meeting and how it could impact the likes of the euro and the DAX. Let's kick off with market expectations as things stand. What we can see here is that essentially you're looking at a 94 or 95% chance of a 25 basis point cut with an outside chance of a 50 basis point cut. That's currently attributed around about 5%. That's according to Icon. Now, if you look beyond that and you look for the rest of this year, you can see there's an expectation of another cut in April. Beyond that, there's a good chance of another cut in June. And then that's pretty much it, right? So you're talking about some front-loaded rate cuts in the coming months. And I think there's going to be a significant amount of interest as we go forward around the so-called neutral rate, or in other words, where are they going to stop? Right. And so, it's easy to look at those central banks that are really sort of front loading the interest rate cuts and think that we're going to see a huge amount of downside in terms of those currencies against the central banks that are doing the opposite, right? Holding off. And that might still have some legs to run. But soon enough, we're going to come into a position where central banks like the ECB are going to be coming out with statements that say, maybe we're not going to do any more. And you start to then look at other central banks that haven't done so much so far, the likes of the Bank of England or the FOMC, and they might be in a position to ramp up the easing. And that's when we see a shift of that narrative. So that's going to be an interesting thing to be watching out for over the coming months. I just don't necessarily think that we're there at the moment. Right now, it's going to be a pretty overwhelming move from the committee towards further easing. But like we've said, like I've said here, by the end of H1, you're going to be in a position where we don't necessarily know we're going to see much more beyond those 3 rate cuts. And that won't be the case for all of the central banks. And therefore, you've got a stagnant ECB and potential easing from other central banks. And that's when things shift. But right now, I think inflation is likely to continue to move towards the downside. I think we're likely to see continued rate cuts from the ECB. And that's why right now there is still the chance of further weakness if we do see a particularly dovish stance. Now, headline CPI 2.4. We did see Eurozone inflation coming out and it came in higher than expected. But we still saw a continued decline, 0.5 in the headline number. You see the figure from last February, 0.6. And so that's why we ticked a little bit lower, but not that much. And 0.5 is actually the highest month-on-month figure we've seen since April of last year. But I would caveat that by saying, look, generally January sees negative readings, as we can see here. And February, often we see that uptick. So December, they want to charge quite high amounts because everyone's desperate to buy for Christmas. January, they try and put on the sales to try and keep people spending. And February, things kind of pick up once again and prices pick up. So if you look at the 10-month annualized, that means that in 2 months' time, where should we be according to the trajectory of the last 10 months? That points towards a figure of 1.2%. So inflation has a strong chance of collapsing over the next couple of months. That by and large is because if you look at, say, the March reading at 0.8, and if you took an average over the last 10 months of the other figures there, the other figures point towards something more akin to like 0.2, right? So if we saw a 0.2 and we stripped out the 0.8 last time around, suddenly you're dropping by like 0.6. And so 2.4 turns to 1.8, and that's in 1 month alone. So there's a good chance we see significant disinflation in the coming 2 months. And that points towards the possibility that markets will price more rate cuts for this year. Because certainly if we're in a position where the Eurozone is stuck in a trade war with the US and we see the economy potentially taking a hit because of that and expectations because of that, why would the ECB think that it's time to draw an end to their easing process? So inflation is going to be really key. If we do see inflation at 1%, people are going to think the ECB have to do more. They need to stimulate more because the inflation picture is showing a lack of significant activity when it comes to consumers. Now, in terms of core CPI, we've seen something similar, right? So it was 0.6, so it came in relatively high. Again, the highest figure since April of last year. But it stripped out the 0.7, so that's why we moved one tick lower, 2.6 on the core reading. We've been largely flatlined for much of the last year when it comes to the core inflation. But like I said, we're talking about big disinflation next couple of months. Look at that figure from last year, from March, 1.1% in 1 month alone. Right, bearing in mind, over 12 months, we want to see 2%, right? They saw over half of that in one single month. That points towards a possibility that we can see some really significant disinflation on the core reading. In particular, if you look at the 10-month annualized, it's less than 1%, 0.93. So inflation over the coming months is due to decline quite heavily. Bearing in mind, we will at this meeting see revised economic outlook for the Eurozone. And ultimately, if we're looking at that, what are we going to see? I think it's difficult to say because a lot of it comes down to conjecture over exactly how things are going to shape up when it comes to tariffs with the US. Also, what's happening in terms of Russia and Ukraine. So probably something quite similar in inflation, maybe a bit of downside in terms of the growth expectations. But quite frankly, this is because they just have to give out these forecasts, right? It's the same kind of thing as if you come to me and tell me, you've got to give a forecast of exactly where the S&P is going to be by year end. You don't know what's going to happen in the meanwhile. It's very difficult for you to say all of this is going to happen. It's going to lead to that. That can be very difficult. And so the ECB will be data dependent in their approach, just like the Federal Reserve. And the data at the moment is relatively weak and there's question marks around it. But you don't necessarily know what's going to happen in the next couple of months. There might be a breakthrough, suddenly cheap gas comes from the Russians through Ukraine into the likes of Germany. That has been driving the German economy lower over recent years. Maybe that completely lifts the Eurozone. Then we see a trade deal with the US and things really start to turn upwards. We're seeing a big ramp up in terms of defense spending plans. So all of these cogs start to turn and suddenly the Eurozone's looking great. And therefore, those expectations around growth could be very different than if there's no deal and the US pulls out of supporting Ukraine. The Europeans pretty much have to go it alone. They have to ramp up spending on Ukraine, but not on the economy itself. And all of these things turn against the Eurozone, right? So these are two very different circumstances. So I would say that those projections from the ECB, you can take them with a pinch of salt because right now there's a huge amount of uncertainty because we're right at the early part of Trump's tenure, right? In a year's time, probably things are going to be a lot more settled in terms of where we stand, but there's still a lot of uncertainty when it comes to those projections. But inflation is very low. We could get down to 1%, 1.5% in, say, 2 months' time. And so that points towards a possibility of further easing or a shift in terms of the narrative towards further rate cuts. This is the outlook in terms of annualized inflation. What we can see here is that the last 6 months for the US, 3.6. So this is essentially my way of showing you, okay, we can see over a big picture what year-on-year inflation is. We can also see what those sort of single months are. But when you annualize different periods of time, you can see the sort of pace of inflation over a certain period of time. The difficulty here is also, like I said, we generally see quite big fluctuations between December pricing where prices go high, January prices where prices go down quite a bit. So I would say the 3 month, you're likely to see some significant jitters. And we've seen that for the Eurozone figure, 2.2 on that metric, but that's spiked massively. So the 6 month, I think, is particularly interesting. You can see the US 3.6. After that, the UK 2.4. Then the Eurozone 1%, Canada minus 1%. So the Eurozone and Canada really on a pathway to really significant disinflation. And that could put pressure on their currencies as a result. Now, this is a chart showing you the comparative 2-year yields. You have different treasury yields and they relate to different things. The 2-year yield is very much focused on where the here and now interest rate decisions are going to be. If we start to think we're going to see more rate cuts from the ECB, that should drive down the 2-year yield. If that happens, at a time where people are expecting less rate cuts from the Bank of England, then the 2-year yield in the US probably flatlines or moves higher. The Eurozone or ECB 2-year yield, Euro 2-year yield moves towards the downside. That ratio then declines, and that decline, if you overlay it on euro sterling, drives the currencies. So are we expecting to see a shift in terms of the likes of the 2-year yield in the Eurozone? Well, they could point towards further downside in terms of interest rates. I do think there's going to be downside for euro sterling or for the euro on the basis of disinflation. If we're talking about the possibility of a massive collapse in terms of inflation next month, then that should provide the basis for the downside. When it comes to the UK, like I was talking about here, you look at that 6-month figure, 2.4. So, it's relatively reasonable for the UK, and that's been sort of flatlining for a while now. So relative stability. There had been some fears around a resurgence in inflation with some of the policies that had been enacted under the Labour Party in terms of national insurance contributions and the impact that could have in terms of prices and being passed on. Relatively strong wage growth in the UK, higher national wage. These kind of things are inflationary by nature, but we've kind of moved beyond that to an extent, but, it still will feed through to an extent. But, there's a good chance, as we see here, that decline in terms of the relative 2 years does put downward pressure on the likes of euro sterling. So let's look at euro sterling. This is a chart that we have talked about quite a bit over the months, and there's good reason for it, right? Like, we're looking at a very nice downtrend in play here. Are we going to see further weakness to come? I think there's a good chance that we do. We talked previously about this rally up here into this retracement. This is the 61.8. And talked about that being a potential turning point, tagged it, rolled over, and that has been playing out very well since then. So we were talking about that back up there. So we're looking at sort of continuation of that really at the moment. So decline, consolidation, decline, consolidation. So there's a good chance that within this, whether we pop and fall off or consolidate and fall off, there's a good chance of further downside. If we see weak growth expectations in terms of forecasts from the ECB, or weak inflation expectations from the ECB, or a nod towards the possibility of further rate cuts beyond the 3 expected over the coming months, those are the kind of things that could put downward pressure on euro sterling. If they talk about, okay, we might do 1 or 2 more, but then beyond that, that could draw to an end. It may not put a huge amount of upwards pressure on the 2-year, but it would potentially set a essentially baseline for where the 2-year might stay. And then we start looking at the relative moves that come from the UK side of things. And if we start to see a more sort of dovish stance from the Bank of England, yes, then you're looking at the possibility of this starting to turn towards the upside. But for the time being, the trend is very clearly defined. If we look here on the daily time frame, that very clearly defined bearish trend playing out at the moment. You can see one thing worth noting here is this low that we have, this historical low from down here. There you go, 82.02. But look out for the near term, 82248, which is the low that we have from December. That's your near term key support level to be looking out for. But as things stand on an intraday basis, it remains relatively bearish here. In terms of the indices, I wanted to show you the DAX. I mean, it's been an incredible performer recently, popping up into fresh record highs. A lot of this is around the idea that we could see a breakthrough that could lead to an end of the Russia-Ukraine war. That war has been particularly detrimental to the German economy. And the Germans are also sort of at the forefront of the industrial sort of business, industrial production within Europe. And so if you're planning to ramp up defense spending, the German economy is probably going to have a significant boost off the back of that. So a number of things really feeding into this. And there's also a perception of US markets feeling relatively overvalued. We're seeing tech stocks weakening. We're seeing the market as a whole weakening around this narrative that Donald Trump could be leading the economy over a cliff right now. And so where'd you go? Europe looks pretty well positioned, given the fact that we could see a deal with Russia and Ukraine, given the fact that they're now looking like everyone's going to start ramping up defense spending. But there is that caveat, of course, around the sort of financial position if we were to see the US pull out of the Russia-Ukraine war, and Europe seemingly going alone and having to spend a huge amount on defense spending. But that could arguably provide a boost in terms of government spending and economic growth for the time being. Some people say that wars are times where you see economies boom in terms of the amount of production that they have, but it's not a good position for the Eurozone to be in by any stretch of the imaginations. So anyway, we've seen this pop towards the upside. We're starting to fade a little bit, but certainly given this rally out from this consolidation phase, if we did see a pullback, it'd be likely to be a retracement unless we break this 22219, and therefore we'd be looking at a potential fib retracement. But let's see where we get on this and take it as it comes. Essentially, we're looking at this as a retracement somewhere. Do we just retrace here and pop? Do we retrace into a deep retracement and pop? Different ways to trade these different types of retracements. I like to take trades on deep retracements, so on the 76.4, on the 61.8 without seeing the reversal. But if we saw a shallow retracement, I like to take it on the breakout. If we see a mid-sized retracement, I like it to come in at ABC style, Elliott wave style retracement into that, and then a rally up through your swing high within the intraday pullback, and that would be the signal towards the upside. So different ways to look at potentially trading retracements. But certainly for me, a very clear-cut bullish trend at the moment. And this is favorable over what's happening in the US markets, because as you see, if I overlay it with the S&P 500 or the ratio between the DAX and the S&P 500, you can see the DAX has been outperforming for months now. From a wider perspective, that's not the norm, right? Normally, the S&P 500 outperforms the DAX. Well, we've been breaking from that norm right now. And so if we're looking for a market to be bullish, I would say probably look towards Europe as things stand. But of course, as with all these markets, there's a huge amount of variation, volatility, uncertainty within these markets. And, as you see these different agreements or breakthroughs, they inform the markets, and it can provide volatility in either direction. So risk management is going to be key as ever. I hope this has been useful. Make sure to like, subscribe for more content. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.